Part I of Chapter 12 outlines the principles and framework of public finance in Kenya. It establishes guidelines for the management and sharing of financial resources between the national government and county governments. Here's a summary of the key points. 201. Principles of Public Finance. Article 201. The principles guiding all aspects of public finance include openness, accountability, and public participation in financial matters. The public finance system should promote an equitable society by ensuring fair sharing of the burden of taxation and equitable distribution of revenue between national and county governments. The use of public money should be prudent and responsible, and fiscal reporting should be clear and transparent. 202. Equitable sharing of national revenue. Article 202. Revenue raised nationally must be shared equitably between the national and county governments. County governments may receive additional allocations from the national government's share of revenue, either conditionally or unconditionally. 203. Equitable share and other financial laws. Article 203. Criteria to be considered in determining the equitable share of county governments include the national interest, public debt and other national obligations, needs of the national government, fiscal capacity and efficiency of county governments, developmental needs of counties, economic disparities within and among counties, affirmative action for disadvantaged areas and groups, economic optimization of each county, stable and predictable revenue allocations, and flexibility to respond to emergencies and temporary needs. The equitable share of revenue allocated to county governments must not be less than 15% of all revenue collected by the national government. 204. Equalization Fund. Article 204. The Equalization Fund is established, and 0.5% of all revenue collected by the national government each year is paid into this fund. The purpose of the Equalization Fund is to provide basic services, such as water, roads, health facilities, and electricity, to marginalized areas in order to bring their quality of services to the level enjoyed by the rest of the nation. As much as possible, the national government may use the Equalization Fund directly or indirectly through conditional grants to counties with marginalized communities. The Commission on Revenue Allocation must be consulted, and its recommendations considered before Parliament passes any bill appropriating money out of the Equalization Fund. The Equalization Fund lapses 20 years after the effective date, subject to possible extension by legislation supported by both houses of Parliament. 205. Consultation on financial legislation affecting counties. Article 205. The Commission on Revenue Allocation shall consider and may make recommendations on any bill that includes provisions dealing with revenue sharing or any financial matter concerning county governments. The Commission's recommendations must be tabled in Parliament for consideration before voting on the bill. Part 2 of Chapter 12 focuses on various public funds established for the management and allocation of financial resources in Kenya. Here's a summary of the key points. 206. Consolidated Fund. Article 206. The Consolidated Fund is established to receive all money raised or received by or on behalf of the national government, except for money excluded by an Act of Parliament or retained by a state organ for its expenses. Money can only be withdrawn from the Consolidated Fund in accordance with an appropriation by an Act of Parliament. Article 222. Withdrawal in case of a vote on account. Article 223. Withdrawal in case of exceptional circumstances, or as authorized by the Constitution or an Act of Parliament. No money can be withdrawn from any national public fund other than the Consolidated Fund unless authorized by an Act of Parliament. 207. Revenue Funds for County Governments. Article 207. Each county government shall establish a revenue fund to receive all money raised or received by or on behalf of the county government, except for money reasonably excluded by an Act of Parliament. Money can only be withdrawn from the revenue fund of a county government as a charge provided for by an Act of Parliament or county legislation or as authorized by an appropriation by county legislation. No money can be withdrawn from a revenue fund unless approved by the Controller of Budget. 208. Contingencies Fund Article 208. The Contingencies Fund is established to provide for urgent and unforeseen expenditure for which there is no other authority. An Act of Parliament shall provide for the operation of the Contingencies Fund and for advances from the fund when there is an urgent and unforeseen need for expenditure. Overall, these provisions ensure proper management and utilization of public funds at both the national and county levels, promoting transparency, accountability, and responsible financial practices. Part 3 of Chapter 12 focuses on the revenue-raising powers of the national government and county governments in Kenya, as well as provisions related to borrowing and public debt. Here's a summary of the key points. 209. Power to impose taxes and charges. Article 209. The national government has the exclusive authority to impose income tax, value-added tax VAT, customs duties, and excise tax. An Act of Parliament may authorize the national government to impose other taxes or duties, except taxes specified in Clause 3 or B. County governments have the power to impose property rates, entertainment taxes, and any other tax authorized by an Act of Parliament. Both national and county governments can impose charges for the services they provide. County taxation and revenue-raising powers must not prejudice national economic policies, economic activities across county boundaries, or the national mobility of goods, services, capital, or labor. 210. Imposition of tax. Article 210. Taxes or licensing fees can only be imposed, waived, or varied as provided by legislation. If legislation allows for the waiver of any tax or licensing fee, a public record of each waiver with the reason must be maintained, and the information must be reported to the Auditor General. No law can exclude a state officer from paying tax based on the office held or the nature of their work. 211. Borrowing by national government. Article 211. Parliament has the authority to prescribe the terms and conditions under which the national government may borrow. The Cabinet Secretary responsible for finance must provide information concerning any specific loan or guarantee to the relevant committee in Parliament if requested. The public debt is a charge on the consolidated fund, but an Act of Parliament may charge all or part of the public debt to other public funds. 212. Borrowing by counties. Article 212. County governments can borrow only if the national government guarantees the loan, and the approval of the county assembly is obtained. 213. Loan guarantees by national government. Article 213. An Act of Parliament shall prescribe the terms and conditions under which the national government may guarantee loans. The national government must publish a report on the guarantees it gave during each financial year. 214. Public debt. Article 214. The public debt includes all financial obligations related to loans raised or guaranteed and securities issued or guaranteed by the national government. These provisions aim to ensure responsible fiscal management, transparency in revenue raising, and prudent borrowing practices, both at the national and county levels in Kenya. Part 4 of Chapter 12 focuses on the establishment and functions of the Commission on Revenue Allocation, as well as the process of revenue allocation among the national government and county governments in Kenya. Here's a summary of the key points. 215. Commission on Revenue Allocation. Article 215. The Commission on Revenue Allocation is established to make recommendations concerning the equitable sharing of revenue raised by the national government between the national and county governments, and among the county governments. The Commission consists of a chairperson nominated by the President and approved by the National Assembly. Members nominated by political parties represented in the National Assembly and the Senate, and the Principal Secretary in the Ministry responsible for Finance. 216. Functions of the Commission. Article 216. The Commission's principal function is to make recommendations on revenue allocation between the national and county governments and among the county governments. It also makes recommendations on other financial matters concerning county governments, as required by the Constitution and national legislation. The Commission seeks to promote criteria for equitable sharing of revenue, enhance revenue sources, and encourage fiscal responsibility. 217. Division of Revenue. Article 217. The Senate determines the basis for allocating the share of national revenue annually allocated to county governments. The Senate considers criteria in article, recommendations from the Commission, consultations with county governors and the Cabinet Secretary responsible for finance, and public submissions. The Senate's resolution is sent to the National Assembly, which may approve, amend, or reject it within 60 days. If the National Assembly does not vote within the specified time, the Senate's resolution is regarded as approved. If the National Assembly votes, the resolution is amended with a 2/3 majority vote or rejected with a 2/3 majority vote against it. The National Assembly may request joint committee mediation if there are disagreements, and resolutions approved by the National Assembly are binding until a subsequent resolution is approved. 218. Annual Division and Allocation of Revenue Bills. Article 218. At least 2 months before the end of each financial year, the Division of Revenue Bill and County Allocation of Revenue Bill are introduced in Parliament to divide revenue between the national and county governments and among the counties. The bills are accompanied by a memorandum explaining the revenue allocation, evaluating compliance with criteria, and summarizing any significant deviations from the Commission's recommendations. 219. Transfer of equitable share. Article 219. A county's share of revenue raised by the national government shall be transferred to the county without undue delay and without deduction, except in cases specified under Article 225. These provisions ensure transparency, accountability, and equitable distribution of revenue between the national and county governments to promote balanced development and effective service delivery at the local level. Part 5 of Chapter 12 focuses on the budgets and spending of the national and county governments in Kenya. Here's a summary of the key points. 220. Form, content, and timing of budgets. Article 220. The budgets of the national and county governments shall include estimates of revenue and expenditure, differentiating between recurrent and development expenditure. The proposals for financing any anticipated deficit and borrowing that will increase public debt during the following year must also be included. National legislation shall prescribe the structure of development plans and budgets of counties, timing for tabling plans and budgets in county assemblies, and the form and manner of consultation between the national and county governments during the budgeting process. 221. Budget Estimates and Annual Appropriation Bill. Article 221. At least 2 months before the end of each financial year, the Cabinet Secretary responsible for finance shall submit estimates of revenue and expenditure of the national government for the next financial year to the National Assembly. The National Assembly shall consider the estimates and review them through a committee that seeks representations from the public. After approval, the estimates are included in an appropriation bill to authorize the withdrawal from the consolidated fund for the expenditure. 222. Expenditure before annual budget is passed. Article 222. If the Appropriation Act for a financial year has not been assented to or is not likely to be assented to by the beginning of that financial year, the National Assembly may authorize the withdrawal of money from the consolidated fund for necessary expenditures to carry on the services of the national government. The amount withdrawn shall not exceed half of the amount included in the estimates of expenditure tabled in the National Assembly. 223. Supplementary Appropriation. Article 223. The national government may spend money that has not been appropriated under certain circumstances, such as when the appropriated amount is insufficient or there is a need for expenditure for an unplanned purpose. The approval of Parliament for such spending shall be sought within a specified time, and an appropriation bill shall be introduced for the appropriation of the money spent. 224. County Appropriation Bills. Article 224. Each county government prepares and adopts its annual budget and appropriation bill based on the Division of Revenue Bill passed by Parliament. These provisions ensure the proper preparation, approval, and management of budgets at the national and county government levels in Kenya, promoting transparency, accountability, and efficient use of public funds. Part 6 of Chapter 12 addresses the control of public money in Kenya, focusing on financial control, accounts, audit of public entities, and procurement of public goods and services. Here's a summary of the key points. 225. Financial Control. Article 225. An Act of Parliament shall provide for the establishment, functions, and responsibilities of the National Treasury. Legislation shall ensure expenditure control and transparency in all governments and establish mechanisms to implement these measures. The Cabinet Secretary responsible for finance may stop the transfer of funds to a state organ or public entity for serious material breaches of financial management measures, subject to specific requirements. The decision to stop funds transfer may not exceed 50% of funds due to a county government and should not last for more than 60 days without Parliament's approval. 226. Accounts and Audit of Public Entities. Article 226. An Act of Parliament shall govern the keeping of financial records, auditing of accounts of all governments and public entities, and other measures for efficient and transparent fiscal management. Accounting officers in national and county public entities are accountable to the National Assembly and County Assembly, respectively, for financial management. The accounts of all governments and state organs shall be audited by the Auditor General. The accounts of the Auditor General's office shall be audited and reported on by a professionally qualified accountant appointed by the National Assembly. 227. Procurement of Public Goods and Services. Article 227. State organs and public entities must contract goods and services through a fair, equitable, transparent, competitive, and cost-effective system. An Act of Parliament shall prescribe a framework for implementing procurement and asset disposal policies, including preference categories, protection of disadvantaged groups, and sanctions for non-compliance or corrupt practices. These provisions ensure proper financial management, accountability, and transparency in the use of public funds and resources, promoting efficiency and fairness in procurement processes across all levels of government in Kenya. Part 7 of Chapter 12 focuses on financial officers and institutions in Kenya, including the Controller of Budget, Auditor General, Salaries and Remuneration Commission, and the Central Bank of Kenya. Here's a summary of the key points. 228. Controller of Budget. Article 228. The Controller of Budget is nominated by the President and appointed with the approval of the National Assembly. To be qualified for the position, a person must have extensive knowledge of public finance or at least 10 years of experience in auditing public finance management. The Controller oversees the implementation of budgets of the national and county governments by authorizing withdrawals from public funds and ensures that all withdrawals are authorized by law. Every 4 months, the Controller submits a report on the implementation of budgets to both houses of Parliament. 229. Auditor General. Article 229. The Auditor General is nominated by the President and appointed with the approval of the National Assembly. To be qualified for the position, a person must have extensive knowledge of public finance or at least 10 years of experience in auditing or public finance management. The Auditor General audits and reports on the accounts of the national and county governments, funds and authorities, courts, commissions, independent offices, political parties funded from public funds, public debt, and other entities required by legislation. Audit reports confirm whether public money has been applied lawfully and effectively and are submitted to Parliament or the relevant county assembly for consideration and appropriate action. 230. Salaries and Remuneration Commission. Article 230. The Salaries and Remuneration Commission is established, and its members are appointed by the President, including representatives from various bodies, trade unions, employers, and professional bodies. The Commission sets and regularly reviews the remuneration and benefits of all state officers and advises the national and county governments on the remuneration and benefits of all other public officers. The Commission takes into account fiscal sustainability, attracting and retaining skilled personnel, recognizing productivity and performance, and ensuring transparency and fairness in its functions. 231. Central Bank of Kenya. Article 231. The Central Bank of Kenya is established and is responsible for formulating monetary policy, promoting price stability, issuing currency, and performing other functions as per an Act of Parliament. The central bank operates independently without direction or control from any person or authority. Notes and coins issued by the central bank may bear images that symbolize Kenya but not a portrait of any individual. An Act of Parliament provides for the composition, powers, functions, and operations of the Central Bank of Kenya. These financial officers and institutions play crucial roles in ensuring financial management, accountability, and stability in Kenya's public finance system. They contribute to transparency, efficiency, and prudent financial practices at both the national and county levels.